Okay, I've started the recording. Uh, Good afternoon, everyone. Good morning. I know I have a few people who might be in the early morning jurisdictions like but thank you so much for making it to today's session. And I know I've received a few questions on what people would want to kind of engage in to understand how they understand treasury bonds, how do they work, and the investment, and why, most importantly, why someone should invest in. Now, if I was having a one-on-one conversation, some of the questions I would ask would be, um, tell me about a little bit of yourself, where I can easily tailor the conversation to a particular person. But unfortunately for this one, because it's a group, I can't, but I'm going to try to be as much elaborate as possible. Where you feel you need clarification, ask me a question at any one point. That way you get the best out of it. We have 2 hours, 90 to 2 hours. So take the best out of it. Ask me as much question as you can and everything that you deserve to know. Having said that, I'm going to start with a little bit of history. I'm in finance, I'm in investments, and why a treasury bonds. Majority of us in Kampala, whether we like that statistics or not, we are going to be, especially some of us who are employed, for all our lives are going to be employed. That's going to be our primary source of income. And to be fully and gainfully employed, chances are you do not have time to start off another business. You do not have time to venture into other things. You just want to have a concentrated family, build that, build your income and everything. But at the same time, even those in business, if you find someone who is very good at trading, that's their biggest focus. There is no chance whatsoever for them to start a second line of business. Not because they do not want to, but you want to give the success to this particular type of business. And yet, even when you look at the biggest of the companies globally, or even in Kampala, now, when we talk about the biggest companies in Kampala, we're talking about banks and insurances. The most significant thing is they have what we call investment income. Why? To diversify your income is the best ultimate flex you can do. Now, if you are employed and you plan to be employed for the next 10, 15 years, and you take certain bold steps to make sure at any one point in time, your income is not only your salary, that's very good. If you have a business whatsoever you are doing and you take a bold step and say, I want to diversify my income for me not to rely on business alone, that's very good. In the global world, their investments are easily streamlined. They have stocks, they have bonds, they have mutual funds, they have index. They have a lot of them. In Uganda, unfortunately, we do not have that many options. So that brings me to the question of this conversation. Why treasury bonds? And before I go into them, how they do and how the numbers look like, why treasury bonds? In Kampala right now, very few businesses you can do or invest money in and have minimal supervision, minimal effort. Like you put in less effort and they can return a 10% profit every single year. 10% profit of your capital. What do I mean? That imagine if you are to start a chapati stall or a simple restaurant, but you have your business, you have other jobs you are doing, you have your whatever you are doing right now, but you get $1 million and invest into a stall, a chapati, and be in a position for you to earn a profit without supervising the person you have put there, you have employed. What are the chances that business will survive 3 years? Not so many. What are the chances that you're going to go and do farming while not being in the village? For example, what are the chances that you're going to go and put 10 million and buy a farm in Masaka and don't go there for a full year, and after 3 years you go and make a profit of that farm? The chances are minimal. But yet at the same time, I want your money to you want your incomes to grow beyond your salaries without all those inhibitors. If you have a business right now, if you're running a hardware, what are the chances that you're going to go and open up a school without you being at the school and your income will grow? Minimal, because at the end of the day, you want to, if you are not physically there, that means you are increasing the risk of your losses. And that's where the treasury bonds come in. Extremely important. That's where they come in. Because with the treasury bonds, the biggest flex for them, oh, let me actually call it capital markets. The biggest flex with capital markets are you put your money, go do your other stuff. You do not stop working. If you are an entrepreneurial person, you do not stop chasing those dreams. If you are whichever capacity or whichever way you are doing this stuff, you continue doing exactly what you have been doing, but while at the same time, this continues to grow. So that's the first flex, that it does not stop you chasing whatever you're chasing. Even if you're a student right now, I know someone who is at a master's who is among us. You can, and they have a little bit of stipend. You continue to study while that stipend earns some income. It doesn't stop you. The second flex we have with the treasury bonds is the return they are offering. For the longest, the first treasury bond or treasury bill, and we're going to explain those, but I wanted first to explain the why. Because when you get the why correctly, when you buy into them, the numbers will flow. The first treasury bond was issued in 1969. That was Obote 1. Actually, let me start talking about it that way. 1969. Since then, every single month there has been either an issuance of a treasury bill or a treasury bond every single month, no matter who is the head of the state, whether it was Amini's time, whether it was the 5, 6 presidents between 1990 to 91, whether it was Obote 2, whether it is Museveni 1 or Museveni 2, there has been an issuance of a treasury bill and a treasury bond every single month. And interestingly, for the longest time possible, the treasury bonds or treasury bills at on average a year have returned a minimum 10%. So when you take a step back and say, what else can I deploy my money and it can assure me 10% minimum in Uganda? For those of us who are not in Uganda, in America right now, the treasury bonds of around 5%, 6%, 5%, 5.5, between 4.5 to 5% right now. 2 years ago, they were offering 2%. In 2019, they were offering almost 1%, you know. But in Uganda, it has been consistently above 10%. And to demonstrate that, it brings me to the first presentation, which I'm going to kind of first demonstrate that. I want to make sure you are seeing what I'm seeing. I'm presenting. Are you seeing what I'm presenting? Someone confirm for me.
Yes, we are.
Perfect. So here I'm presenting one of the Uganda's treasury bonds right now. And this is the live data which it's a system, it's a routers for those of you in business who track things. Let me do it at monthly. From 2015 to where we are 2025, these are the last 10 years. This is the average of how Ugandan treasury bonds are returning. And when you get that confidence that in 2015, they were at around 13 to 14%, it grew to almost 18%. And why did it grow? We all know what happens every 5 years. In 2016, we remember the election. We are almost there, 2025, and I'm going to explain to you that. After the elections, the rates go down. And this is where they are. Okay, the person was joining. This is where they are. Then, because after the elections, there is a little bit of withdrawal of cash from the economy. Then they continue to play that what we call the cyclical kind of rate. 2021, 2022, they go back to 16, 17. Then they still come down to 14. Now we are back at 16 and up increasing. So you literally always what I always say lately is you are the lucky. At this point when you are getting interested in this, it's one of the perfect opportunity because we are in that cycle where rates are just increasing. That if you have a 10 million, as we're going to demonstrate, this is the time you want to enter. You never want to enter when the rates are going down. But this was to demonstrate to you. This was to demonstrate to you that over time, these are 10 years. I can go on for 20, 30 years and you will see it because this is live data collected. This is a system. It's not even mine. This is routers. You know, they have never gone below 14. So that gives you assurance that for as long as we are still in there as an economy, which is already a risk economy, you are guaranteed at a minimum 10%. But I always say we look at 13, 14% and above. And like I said, this is not competing with your salary. This is not competing with your business. You should continue doing those. But this is the extra income you are deploying that by doing almost nothing, but by signing a form once every 6 months or once a month, you almost deploy that capital to bring in 16%. You know? So there is not so many things you can do that can give you that. And when you accept that the bonds are not competing with a business that can give me 100% profit in a year, then you accept that, okay, to build wealth, it's going to take time. Are there businesses that you can do that can give you 100% profits in a year? Of course, yes. But what are the chances that you're going to also lose that money? Because the higher the profits or the risk, the higher the losses. When we talk about risk, we are talking about it risk loss. In bonds, you are assured in every 3-4 years you get back your capital and enjoy your profits going forward. Having said that, that gives you assurance that why you would want to enter this is the return that the bonds are offering is indeed fairly good compared to a typical business you're going to do and all the limitations that would come, especially if you are employed or if you have other businesses. How do you diversify that extra income to bring in more cash flows? How do you diversify to bring in more multiple streams of income? That's where the treasury bonds come in. Having said that, that brings me to now to the actual product because now we have established a baseline. Then I come back to what is a treasury bill, what is a treasury bond. I will present this. Now, lately, I've come to tell people a treasury bill and a treasury bond, they are the same. They are in a category of what we call government securities. Government borrowing money from you and I. I actually, in the last 2 years, it's when majority of people, individual people, borrowing money from like you and I investing in. It used to be banks, NSSF, insurance companies, and all those major companies. Now the interest is picking up. And if you're on this call to understand this, you are coming at the right time, and I'm going to explain you why. But understand these two things. Whereas I'm saying there is a treasury bill and a treasury bond. Know the difference and know what you should buy, because when you go to the bank, they are not going to make for you that difference if you are not sure. A treasury bill is the short-term version. If you lend government money for less than 1 year, you are falling into this category of a treasury bill. Now, from Kakande's perspective, I do not recommend this. And I'll tell you why. The treasury bill has a percentage. If I am to present the calendar of it, everything on this is a tax. Treasury bills, however, they attract a 20% tax. I've gone far away. The treasury bills are these. They attract, however, what I'm going to write here as a 20% withholding tax on income. Now, what that does is, this is what it means. A 364, a 1-year treasury bill, if it gives you, if we are to do some math here together, I'll do it here completely. Let me know when you can see it. Someone is trying to join in. If a treasury bill offers you a gross return of 13%, right? Which is good because that's what they're going to tell you 13%. But remember, there is a 20% withholding tax of the 13%. So times 80%, because that's your net return. Yes, second way is my calculator. I have this friend of mine. So at 13% times 0.8, you end up getting a net return of 10.4%. So that whereas that treasury bill is being marketed at 13% return, after tax you are getting a 10.4. And we all know you can get a higher rate of 10.4 in a unit trust or a money market fund. So if your goal is to invest for just 1 year, if your goal, because the only way you should buy a treasury bill is if your goal is to just deploy capital for just 1 year or less than 1 year. If your goal at any one point you say, I have this 10 million, but I will need it in 2 years, in less than 1 year, take that money to a unit trust. You will make more money than putting it in a treasury bond. It's a return versus understanding the product. Because the uniquely unit trusts are giving 11% and above. This year, some of them gave 11.5. So take to a unit trust, any, whichever, but do not buy a treasury bill. Even if your goal is to deploy your money for just 3 months. Now, when people do that, they tend to forget that a unit trust is almost the same as a treasury bond or treasury bill. It's just that the other one, you can access your money whenever you want. But don't buy a treasury bill. Leave the treasury bills to the banks and the insurance companies. For you, if your goal is 1 year or less, take your money to a unit trust. Any question on that before I move on to a treasury bond? Because it's insistive on this point. Yes, they are sold. Yes, know when they are sold and try to avoid them because you have a better product out there that can achieve the same exact goal. Okay, someone has said we continue. Now, having understood treasury bill, this calendar here, that means be careful. Every time they tell you there is a sale of a security, then you have to ask yourself, is it a treasury bill? Is it a treasury bond? It's important. Yes, is it a treasury bill? Is it a treasury bond? When they tell you it's a treasury bill, like, if you're selling a treasury bill, I will continue my journey. You call me when you're selling a treasury bond. Now we go to the treasury bonds. In the treasury bonds, you will notice they start from 2 years, 3 years, 5 years, and above. Now the question is, which one is good for you? The 2 years, the 3 years, the 5 years, and above. Now, typically, let's start from the tax perspective. These have the same have the same 20% withholding tax. But it doesn't mean that they are worse off. The 2 years, 3 years, 5 years have a 20% withholding tax. Now, treasury bonds are some of the best way to plan, because you can easily say, I want to do something in 5 years. So that means you're going to buy a bond of 5 years, 3 years, 2 years, depending on your time horizon. The question becomes, is it worth for you to buy a 5-year bond, a 3-year bond, versus taking your money in a unit trust? Let's look at the numbers. We're going to break it down a little bit slowly by slowly. Now, what I'm showing you here is unfortunately, this one I will share most of the documentation, but this one I can't share it because it's a Bank of Uganda's pricing. There is a little bit of legitimate protection around it. But if you have tried to get into the bond, or if you have seen me writing about it, I tend to present a PDF version of this. This is the current year 5-year bond. It offers a coupon rate of 14.25. It has an interest rate of, let's say, 16, which brings me now to these 2 points, which I must first explain before I even go in further. Because this is the language you're going to see. Rate, and what is the interest rate, or what we call the yield to maturity. A coupon rate is set the first day the bond is auctioned off, the first time. What me here? The first time it's brought to the market. A bond can be brought back to the market every single now and then. But at one time it was issued. For example, if we go back to this and we go to description, and if I'm to make this a little bit bigger, you will see the first time it was auctioned off was in 2014. So this 14.25 was set the first date was auctioned off in 2014. So the coupon rate never changes. When it is set, someone is saying they lost the screen share. Are you everyone seeing it?
No.
I'm actually seeing the screen share. I don't know. I'm seeing it.
I can see it.
Seeing it as well.
I'm not seeing it.
Oh,
Yeah,
guys,
I'm
when you're
also
not
seeing
seeing
the-
when you're not seeing a screen share, let me know. It's important because everything is
Now we are
is
seeing it.
okay. Now it's back, right? Okay. Everything I'm trying to present these concepts for you and demonstrate them. When you don't see something, let me know. It's a refresher, just right. Coming back to these two concepts, I'm moving between different tabs to demonstrate to you some things. So that's why maybe you might get lost a little bit, but it will come back. The coupon rate never changes. When it's set, it is set. Whether it's for 2 years, 3 years, 5 years, 10 years, 20 years, it never changes. The interest rate changes every single time. Actually, there is a saying within us who trade a lot in treasury bonds that even when Museveni coughs, it can have an impact on that rate. If they are to announce right now that they have appointed a new governor, that rate will change. It's one of those news we are waiting so hardly, and it can easily make a fire sell or a fire buy, and it impacts the interest rate. The question becomes is, when you are buying a treasury bond, what should you pay attention to? The most important thing you should pay attention to is this. The most important, when you're buying treasury bonds, this interest rate, I'll explain to you why. The interest rate, or what we call the yield to maturity, is what determines how much you pay, which is the most important thing. In an investment, you want to always pay as little as possible. Now, you have no control whatsoever on the coupon rate. That one is done. It's set by BOU and the primary dealers, done. But you should always monitor this interest rate, the yield to maturity. When they announce the results, pay attention to the yield to maturity. It's the most important one. I'll actually go at length and I say, I'm actually okay to buy a treasury bond with a 10% coupon rate, but on a 16% yield to maturity or interest rate. Why? I'll demonstrate it to you. Let's take for example, let me duplicate this such that I can demonstrate it better without duplicating. Let's assume this is a 10% coupon rate. Now, when people see this as 10%, they get discouraged, like that interest rate is so low. Will I make money? They forget what determines what for you to make money is the interest rate. When this column is, let's say, 16%, and you want to buy a bond of 10 million, you see, you are paying 8.5 million, right? Now, follow with me here because this is where it's very important to understand. You see this, we have made it 10%. This one has made 16%. Now someone ends up paying 8.5. However, imagine this was 14.5 and this was 15. Or let me call it actually 14.5. And we want also to buy for 10 million. So who do you think is going to make more money?
The other one.
You see, this one is paying, this column here, what we call all-in cost, is what you pay. If I'm to write it this way, what you pay, let me write it that way. This is what you get out of your wallet or your bank and pay for this bond. Both of you have paid for the same bond, a 10 million bond. This person has paid 10.5 million. This person has paid 8.5. Now let's work it out. After tax, I'm going to talk about the tax element. After tax, this person has made 14 million. Then this one has made 16 million. On the face of it, this person who chased the coupon rate has made more money because he has got back 16 million. However, the actual profits he has made is 5.8 together. Then this person comes in and they say, how much have I made? I made 14.5. But if I get 14.5 minus what I paid, I'm at 5.9. You can see. Now imagine if someone had invested 100 million, 20 million, 300 million. This number, the person who tracked the yield to maturity, higher yield to maturity, is making more money than you. I don't know if that is a little bit clear. Let me demonstrate it further for the bonds that exist on the market. Let's come to the 20-year bonds. They are there because I know people always ask about them. I'm looking for one of 18.5. Yeah, this one. Let me move it this side. So imagine you have 30 million. You want to buy a bond of 30 million. Let me take out all this noise. We don't need that. And let me expand this for you people to see it. And let me take out all this noise such that it does not distract us. So we have said this one, it's already set. You do not do anything. You cannot do anything about 18.5. This is what the market gives. So let me even actually make it 16. So that means right now for someone of 30, actually let me even make this 100 or 50 for fair convo. That means the person who is buying this bond, they're going to buy a bond of 50 million and they're going to pay 61 million. So what is the after-tax comparative? Yeah. I know someone is surprised. Yeah, that's when we talk about premiums and discounts. I'm going to talk about them, but let's do it that way. So that person is going to get a total of, after tax, so they would have made the total of around 200 million. Let's say 200, let's round it off to 200 million. So a client comes to you and they say, Alex, I want that bond of 18.5. You try to explain to them, but you don't make money off that. They're like, no, but it gives a higher coupon. So you have to go through this. Now, this is one bond, a 20-year bond. Let's go to the other 20-year bond of 15%. And let me leave it at around, let me even leave it at 17.1. So we also want a bond of 50 million comparative. The bond of 50 million, both of them have bought 50 million bond here. And this one is also 50 million here. The difference is this person is going to get, in the same period, 174 million. So on the face of it, this person and this person, this one seems is making a little bit more money. You know? However, when you do this, they are at 138. What about this one? See? So now the question becomes, what serves you better? Actually, let me do this. Let me stabilize this in the right way, because if it is not, okay, yeah, exactly. So then you have to sit back and you ask yourself, what serves you better? It's never this coupon rate. What you should be paying attention to is already the yield to maturity, and how much does it trigger for you to pay at the end of the day. If at any one point this one, you go to a bank and you want to buy this 18.5 and they make it to you buying it at 15%, then it's eating away your profits. Right away, it's eating away your profits, because it means you're going to buy a bond of 50 million and they're going to make you pay 64 million. Then you can easily come to this bond and buy it at around 17.4, which ends up happening, and then you have a higher profit. Why isn't it not changing? Okay, I don't know why it's not changing, but then you have more money you can make, because you're going to buy a bond at a cheaper cost and make a little bit more money from it. Okay, yeah, it's capturing everything. So when you go to buy a bond, coming back to this 5-year bond, where is it, which we started from, always try to make sure whatever bond you are buying has a higher rate here. Forget the coupon. Always go for a higher rate. Even when you're negotiating the bond, whether you're buying it on the secondary market, this is what you should be paying attention to. It's what determines what you end up paying, which you want to be a cheaper version. Having said that, it comes back to the point which we started on. Coming back to this, the 2, 3, 5-year bond. Now, the 2 and 3 years, if you are investing for 2 and 3 years, you want those rates to be as high as possible. Let me come here to the 3 years. The 3 years, the last 3 years came at around 16%. Right? At 16%, it means every single year you are making a profit of 1.1. At 1.1, remember, you invested in just 9 million. So that is a profit of 11.7. Now, 11.7 is almost what you get in a treasury bond, in a unit trust. So most times I also tell my clients that the 2 years and 3 years are not worth it. You might as well put your money in a unit trust. Because for as long as interest can give you around 11, 12%, you are better off that side. However, when we enter the 5 years, it came out at 16.3. So this is your investment. The 5 years, then all of a sudden, you have this plus that. That's what you make in a year. You get paid twice a year. So then that over your investment, and all of a sudden it's 12.87. Now we all agree 12.87 is higher than what unit trust will give you. Now we have entered into this, that, and that. On this one, I would almost certainly tell people, go to put, if you want to invest for 3 years, put your money in a unit trust. If you think of 5 years and above, treasury bond. I'll pause at that point to see if we are okay up to that level. Okay, I think we are good to go. Then we come to, yes, Gilbert.
Sorry, apologies. That was just I was just moving on the screen, but it's okay. I don't have a question at the moment. Yeah.
Perfect. Then we come to the 10, 15, and 20 years. This one automatically they have a 10% withholding tax. Now these are for me what I call where people really make money. Imagine for a moment you're like 35, 45. For as long as you still have 10 years before, if you're employed, you know you have 10 years before retirement, more than 10 years. You are 35, you have 25 years before then. Never buy a bond that is less than 5 years. You can only buy it maybe for the sake, you know, you have to do something in 3, 4, 5 years. But otherwise, come to the 10 years and above. The tax on that is so small, yet you can make more money from that. And to demonstrate that is here. A 10-year bond will give you, they came out at 16.3. I'll make it a little bit bigger. So that means if someone wants to buy a 10 million bond, they're going to pay just 9.1 million. And they're going to earn money for 10 years, which is a total of around 22. How much is that? No, that seems, yeah. So it would have doubled your money before anything by over in that period. Just by just starting with 10 million, by just putting in 9 million. Imagine if you put in 100, then it's more money. And here I've not yet talked about compounding. I'm coming to there. This is just showing you the cash flows you're going to make every single 6 months. Now, even if you say I'm investing in treasury bonds to facilitate my income for or supplement my school fees for kids or doing anything, you can do it and knowing you have every single 6 months some money is coming to you and you spend it the way you want to spend it or reinvest it later. Then you come to the 20-year bond. Now that one is even better. 15-year bond, that is even better off lately, you know. You want to put in a 10 million right now, and it will give you more money going forward. All right. So then the question becomes, when you look at these, you have to be patient enough to say, I have 10 years, I have 15 years, I have 20 years to go. Am I willing to be patient enough to get the best benefit out of my investment at a 10% withholding tax? Because like we have seen, and what people always ask is, but let's use like this example. This is the money you pay. We have already understood the coupon rate, interest rate. So this is the money you pay. And every 2 years, every year they give you this times 2. Let me even just multiply times 2. That means this divided by this. That is your actual return before compounding. It's 14.29%. There is no, if you know you need trust giving you that, you tell me right now in Kampala, I would want to give them a little bit of a wager to my money. And this is before compounding or anything, which we are coming to it. When you come to the treasury, to the unit, to the 20-year bond, and I now have a client of mine who I convinced to put into a 20-year bond. Imagine you put in a 50 million, and every single 6 months they give you 3.5 times 2. That's the money you get in a year, you know, and it's that divided by what you have invested. And when you put that into percentages, 15.3 after tax, that is after tax. How many businesses you can do that can guarantee you a 15.3% after tax for almost 10 years plus, where you know for as long as you have bought that bond, every single year you know you're going to make a 15.3%, of which if you have done this 50 million as an investment, let's see how many it takes you to make 50 million. You make it in around 6.7 years. Then you'd have got back your initial capital. Then from here going up, these are just profits. And now I'm using 50 million, it might be too much. We can use any figure you want to use. It doesn't change anything. 10 million, it won't change anything. You'll make your 10 million in 6.5 years before compounding. Then you enjoy for 9.5 years, you're enjoying just profits. You know, even if you have more money, like I said, I am talking to different people. Let's assume you have a 200 million here. Okay, that's a 2 billion. It's the same thing. All of you are going to come back to 15.3 of return every single year. Now I track SP and 500. I have a friend of mine here who invests in the US stock. Even him, he knows it's the best, one of the best index you can ever invest and sleep in. For those who can, is the S&P 500. Rarely will it average over a period of time, let's say 10 years, and it has averaged more than 13%. Actually, I think for a period of 10 years, it's averaging around 9 to 10%. Here you are locked in 15.3. Now that's the beauty of these 10, 15, and 20 years. But it does not stop there. For you to benefit in a treasury bond, you must be willing to take a long road, let me call it that way. And which takes me back to maybe some of the conversations we have been having online, if you have been reading one of 2 articles and replies to different individuals. To get rich, there are ways you can get rich by landing on a landmark. Some people would say if you marry right, you are sorted. To others, you get a good deal with a project and all of a sudden it changes everything. But from statistics, we always say those are the outliers. The majority of us are going to do the hard road, the slow but consistent over time accumulation of our wealth. That for as long as I take calculated risks, I deploy my income. For it to deploy my income, I should be willing to wait between 5, 10, 15 to start seeing tangible changes over time, which is what we call the compounding side of it. That if I come to this, and I'm going to present 2 different documents, but let's start with this one. Let's use a 50 million, which we have looked at. I'll take that one out. I'll expand on that. Right now, you say, Alex, I have 50 million. I've listened to this message. It's time for me to enter, but how do I grow my money? We have seen if you 50 million, you are going to make a minimum of 7 million every single year. The goal is to say when you buy your first bond, every 6 months, they're going to be giving you a 3.5. Give me a second. Every single 6 months, they're going to be giving you a 3.5. If you are patient enough, taking the high road, having the behavioral side of it, to say every time they will give me a coupon, I'll buy another bond. Now, it doesn't matter whether it's the exact bond or another type of bond, just keep buying bonds. When you take that high road and you keep doing exactly that, you're going to wake up, we are in 2025. In 2026, your bonds will have gone to, by the end of 2025, it will be 57 million. 2026, 64. When you keep reinvesting the income that is coming, that's the compounding element. Now, in a treasury bond, it's not automatic, but that shouldn't deter you. Man, this money comes once every 6 months. What is it taking 10 minutes to sign a form and take it to the bank? I don't know. BOU will one day come up with a system. We are waiting for that. But even if before it comes, it has nothing, it shouldn't stop you from taking that high road because you're getting a 14%. It's more than the 11, 12% we are getting in unit trust. That money, as it compounds, it's much more. In 10 years, that 50 million will be close to 185 million. You have not added in anything. You have continued your work. You have continued your job. If you have business, you have continued with your business. But your money has grown by just leaving it there. You have not added in a single coin. But you put in 50 million and you're using that to reinvest it over and over. You are 35, you do it for 15 years. By 15 years, it's 356 million. If you are still young here and you're like 40, you have 20 years to go. By the time of 20 years, it's over 600 million. You started with 50 million. Even if I change this and I bring it to 12%, in the 20 years from now, you'll be over 420. Now, if all you started with was 50 million, and you wake up one day when the time for your retirement comes and you have 400 million, and 400 million is bringing in over 50 million in a year, you would have won. At that point, you will sit back and be like, I've built my wealth in the simplest but consistent way. Now I'm at a point where I know it's not going down. That's compounding. The beauty of that is when you start with 50 million, you do not need to stay with 50 million. You can say every single month, for me as Edith, I can afford another 300K every single month. Let's assume you start with 10 million here. But you sit back and say, for me as Edith, I can afford a 300K every single month from my salary or from other incomes. You go buy another bond, it's okay. You say every single month times 12 because it's for more. And you do it that way consistently for maybe for the 20 years. You will wake up. Imagine you started with 10 million and every single month you put just 300K. By the time you're at 20 years, you have a 400 million capacity. Now I know a lot of us who are working, who have worked for 3-4 years, we can afford the 10 million. We can somehow find a way to make it. And somehow, if you earn more than $1 million plus, before you have so many responsibilities, you can somehow sacrifice a 300K. And you consistently do it. At the end of the day, instead of leaving that man on a bank account, you will one day wake up when it's 400 million. But even if you start with 5 million here, and you can afford just 150 here, you know, it will grow because you started with just 5 million. Now, for those of you who have more money, you can say, I can start with a 200 million. Instead of you chasing wild games of, let's say, let me go open up a restaurant, it will make me more profits. You have 200 million. There are times I will convince you, like, do you know how to run a restaurant? No. Have you run that hotel? No. Put your money in a bond. Then every time you have that 1 million, you put it there. And you see your money grow for you to turn into a billionaire in 10 years without you doing anything. And,
Alex, I have a question before you go forward.
yes, Edith.
So let's say like me, actually, my peak is I'll definitely start with 5 million because that's what I have, but I'm interested to invest. And you talked about additional capital invested, yeah, in this graph as I can see here. Does this compounding figure do you open up a different instrument, or you just it's additional to your account? Like 5 million, and then I say every month I'll add another 150. How do I compound this? My agent, what does my agent do? They top up on the 5 million. Does it come as an additional to the 5 million? That's what I haven't understood yet.
Okay, so there are two documents.
Alex,
Yes, Juliet.
may I also add a question you answer
Yes,
once?
yes.
Yeah, because it relates to the content you've presented. Now, sorry, there's an alarm going off. Sorry, do you hear me?
Yes, yes, I can hear you now.
I see from the documents, they mentioned that a minimum investment is 100,000, but what makes economic sense from an investment point of view? Because you also mentioned that you can put aside 300,000 per month. Would you advise that I put aside 300,000 per month and I buy once a year when it has accumulated? Or we can have lower thresholds that even 500,000 I can already buy and it will make economic sense.
Okay, thank you so much. Now, when I'm developing this kind of Excel, right, I try to develop it in the simplest way possible without breaking it down, and I develop it at a year's level. But lately, I tell people, the earlier you deploy your money for it to start making money, the better. If you wake up and you have 5 million, do not wait for it to become 20 million for you to invest. Start with what you have. Now, the extra investment, the 100K, the 200K, the 300K, when you have it, buy the bond. Why? Let's come back to this. Let me even use just this one here. I'll bring it to 300K, right? Now, to someone, they are going to say, but if I put there 300K, it's going to be earning just 20K. Hell yeah. If you wait for it to make a year, you're not going to earn some income in these first 2 months. You have missed, how much have you missed out? Maybe 38. Is 38 a real money to you? If you're investing only 300K, it means 40K is a money to you. Why don't you deploy it? Okay, and someone will be like, maybe 300K is a little. I'm like, okay, maybe deploy it every 2 months. So every time you make a 600K and put it there. Why? Because it will keep earning. When you keep it somewhere for it to wait for a year, it has earned nothing. The person who has invested there 100K, 200K in the first 6 months is somewhere far away. By the time for you wait to invest it when it has a 2 million, a 5 million, he's already gone. And that's what you have missed out. It's okay, and which goes back to Edith. When you open up your investment account, it's going to end up looking like this. You know, this is one of the portfolio I manage for a client. That they're going to say, you think we bought all of these at once? No. We consistently buy. Now, I assure you one thing. When you enter this bond market and say consistently every 3 months I'll buy even if for 1 million, in 4 years you're going to have your portfolio looking like this. You will never be having one bond. You won't wake up when you have 10 bonds, 15. That's okay.
Okay,
Extremely
that
okay.
was my question.
Yeah.
That with one account, I can have multiple bonds.
Yes.
Okay.
Your goal is to just
Now
going back and buying, and what you do, the only limitation for you to invest in a bond, especially if you want to invest in them, the only limitation should be, do I have money? If you have money, your second question should be, which bond am I buying? What is its interest rate? And when you figure that out, you buy that, life moves on. And then one day you're going to wake up when you have 10 bonds. Yeah.
Okay, so even 300,000, I can buy a bond for 10 years at only 300,000 shillings.
Yes.
Ooh.
Which brings me to the third concept maybe now. I'll write it here for me to explain it. Primary market, secondary market. Now, over time, I've developed this assessment. If you have more than 2 million, but less than 50 million, actually, let me take off that. Let me take off that. If this is all the money you have, I would almost 100% tell you always go to the primary market. Why? The cost of buying in a primary market is cost. I'm typing them here but I will try to explain them. The cost is always 23,000. The banks always charge between 15,000 to 23, but let me use 23,000 because that's what most banks charge. So when you invest for 2 million or 50 million, you're okay to incur this cost. You're okay to incur that cost. You won't feel it. But for someone who has less than 2 million, that means in this case, let's say someone who has 300K. We have seen a 300K earns what on this side? 38. So you do not want to buy in the primary market because they're going to charge you this 223,000. It was eating away your profits. You can go to the secondary market. Why? The secondary market doesn't charge you this cost. When you're buying from the secondary market, the cost is 0.
Who is the secondary market?
The secondary market is the banks, different banks. Your bank you bank with. However, the primary market will give you, for example, 16.5%. This one will give you maybe a 15.5%. Now, let's demonstrate it this way. If you go to the secondary market and you're going to get a 16.3 and they charge you a 23K, you would have ended up paying that plus that. So your total cost would have been that for secondary market for people who have little money. For to go in the primary market, secondary market, you're going to do just 15.5, for example. And this is the total cost you're going to spend in the primary market. So you see the person who has bought from the secondary market, they have spent less money than those who went to the primary market. Even if the one for primary market got a higher rate, it's because of this 23,000. So when someone has less money, just buy from the secondary market. So Edith, to go to your question, which you said if you have 300K, just continue buying your bonds, but just buy them from the secondary market. Just go to the bank and they'll give you a lower rate, but it will be compensated by saving on the 23,000 and just keep accumulating your bonds. If someone has 100 million, for you with this money, you can negotiate a very good rate. Actually, if you do not know, you come to the people like Kakande, we will pull for you 16.3. And you can invest at any point you want. You don't need to wait for the secondary market, the primary market, which happens once a month. The next primary auction is on 20th Feb. There are people who are already right now investing in bonds because they have the money. So you're like, go to Kakande, he will charge you 500K, he will bring for you a very good rate, you will auction it, and you'll be good to go. I know there are people who invested within the same and they had money, they had a profit by Jan. And we shall look at the numbers and say this number makes sense. We lock it for you a good deal and you're good to go. So there is that. When you have more than 200, 300, which brings me to the concept of competitive and non-competitive bids. Now, these ones are all for primary market.
Sorry, Alex.
Yes.
Just to follow you. Please, this primary market way, exactly, because secondary market, you said you go to the banks, but primary market, where do you go?
You also go to the bank, but you fill up different forms, which I, okay, you have brought that up. Let me go into it right now. Okay, let me first finish off this one. Then I come to those forms. The primary market is what we call competitive. Now, competitive is for people who have more than 200 million, which most times it's anticipated that those are the banks and the insurance entities. The non-competitive is for all of us who have less than 200 million. This one is more than 200 million. This one less than 200 million. The question is, let's assume you are Steve and you have over 200 million. Do you go to competitive or non-competitive? I would say try carefully never to go to competitive, because in competitive they can reject your bid. Yet in non-competitive they will accept all your money up to a maximum of 200 million. So let's assume at one point you say, oh, I'm Ruth, I have my money. Nah, man, Alex, I have 500, I want to invest. At that point, you go to the secondary market. You can negotiate up to the rate they are getting out there, and you deploy all your money at once at a very good rate and at your terms, because you have a lot of money. Than trying the competitive rate, especially if you cannot know how to price your bond and they get your bond fully rejected, or you end up overpaying because you don't know how that market works. Because competitive is obscure. It's so much by the banks and they talk to each other. And they're okay for them to get rejected because, man, they're going to bid for a 200 billion and they accept of just maybe 20 billion and they're okay. Yet for you, you have maybe 500 million and they can reject all of it. So for anyone who at one point when you have more than 200 million, just go to the secondary market. Now to answer the question of I'm looking.
Juliet.
Juliet, yeah, I'm trying to look for the forms. See, why can't I see it? Give me a second, because it's the difference is in forms. CDS. Okay, those are people's forms. Oh, the forms I'm seeing. Okay. Oh. Okay, that's not the one I want. Where is it? Give me a second, guys. And I don't want to present people's forms. Okay, perfect. Here we are. I'm assuming you are seeing Bank of Uganda form, eh? Unfortunately, both for primary market and the secondary market, the road is one through your bank, at least for now. If you ever want, and your target is that you must buy from Bank of Uganda, which is the primary market, the form you must fill up should look like this. Pay attention to how it looks. It even has the word bid application. If someone gives you any other form that doesn't have that bid application, they are triggering you. When your goal is to buy from a secondary market, and that was your intention, the form you'll fill up will look like this. It's in tabular form. There is totally different forms. They should never be confused. Now, if at any one point your goal is to buy from the primary market, which this is the most important one, the form you should do it should look like, should have that, should look like that, should have that. It's different from the form you do when you're buying from the secondary market. It's in a tabular form. So when at one point when you're investing and you're walking out and you're like, I'm going to the bank, I'm going to bank A, I want to buy a 10-year bond, at 15 million, and my target is to buy it from the primary market. That means when they give you the forms and they give you a form that looks like this, I can know. I know better. I came to buy a primary bond. They will have to give you a form like this. I hope, Judith, this has answered your question.
I beg your pardon, Alex.
Yes,
So the top
please.
is primary market, a lower form is secondary market, or
Yes. The top
okay,
form is the primary market. If I'm to write it here, primary market. And the way it looks, you can see it looks uniquely different. It has even the word bid. It has even the word maybe auction. That's when you're buying from the Bank of Uganda or from the Treasury Department. It's uniquely different. When you are handed a form that looks like this in tabular, they are almost the same things. But if it looks like this as a tabular, this one, this is a secondary form. So at any one point, it's not easy, it's not hard to remember. But the good thing, the day you make your first investment, you will always know. If you buy from the primary and the secondary, you'll know, okay, this is the form I have to always fill up. So that one is, I'm not even worried about that. But yes, Aini.
Yes, just a question.
Mhm.
Is it okay? If I'm trying to get the tone, is it that some bankers can give you a secondary market form when you actually want to go in the primary market, or they just take advantage of your ignorance? Is it something they do intentionally or something like that?
So let me not call it, I would say intentional, but let me not call it illegal. And you're right. So I'll give you, let me come back to this auction form, right? Let me demonstrate to you how it would happen. We are in what? We are in Feb, right? Feb 1st. So the next auction is on Feb 19th, 20th. That, which is the 2-year bond, 5-year bond, and the 15-year bond, right? So this calendar is for the for the primary auction. This is the Bank of Uganda bond calendar. So it means, let's focus on this 5-year bond here that we have already looked at. We are familiar with this one. Imagine on Feb 10th. Feb 10th will be a Monday. Next week, you have gathered your incomes, your funds. You say, I want to go invest in a bond. You have around 8 days to go before the auction. You go to the bank, you say, I want a 5-year bond. Now, if you don't know them, remember this bond it has been on the market for the last God knows how many years, 10 years. The bank you're going to go to has it. They also want to sell it off. They make money by buying it from Bank of Uganda and they sell it. They don't want to keep it on their books. So when you go there and you say, I want to buy the 5-year bond, their first instinct also, for what I've seen, is they will tell you they'll give you something that for some of you have seen something like this. Where is it? Something like this. A bank sends you something like this. When a bank sends you something like this, there you just know. Or they print it out for you like this, there you know that's the secondary market. You're about to buy into a secondary market. So because you didn't specify for them, they're like, we are here to make money. Especially if you go to certain branches, they will sell it to you without telling you that, oh, wait a minute, that bond is actually coming on the market in 10 days. For as long as you are between 5 to 7 days, you are better off waiting to buy from the primary market. So you must be insistent and say, okay, thank you so much for your offer. Especially if your rates, you fall within this amount of money, 2 million, 50 million, and your target, or even more, even if it's 100 million, but you want to buy from the primary market, and you know this is the bond you want, the auction is coming up in 5-7 days, you tell them, no, I thank you, that is good, but I want the primary form. You fill up, sign it, give it to them. So it's not like they are doing something illegal, because that's part of the trading. It's just that somehow you don't know what you want. You know what you want, a 5-year bond, but you didn't specify. And to them, they're going to go buy it for 10 million and sell it to you at 10.5. Now they have made a profit. They're in the business of making money. So I don't want to call it illegal, but that's what happens. So, but your information, your grounding is for you to say, I know what I want. I know when that bond is coming. Maybe I read Alex's post on Twitter or on his Substack, and he said there is an auction that is coming up. I make that post once, 2 weeks to the auction for people to prepare. Now you have seen what is coming. Why should you buy it on the primary market, on the secondary market? Especially if your amount is within 10 million, 15 million, 20 million, just buy it from the primary market. I hope I've answered that matter. So these forms, understanding these forms is important. However, there are times you're going to be there, like for example, right now, coming back to the calendar, where is it? And you want the 20-year bond. The 20-year bond is coming back in March 19th. It has over 2 months to go. At that point, you don't know what is going to happen. Right now, and you come to Kakana, and I'm like, I'm going to get it to you at 17.2. You have 100 million, yes. Put it on your account. Let me go negotiate a deal for you. Because waiting for 40 days, you might be missing out on income, or you might be missing out on the pricing that is available right now. So there you say, I got the secondary market, and that one you want to do it for people when they have a little bit of more money. Because when someone comes with 50, 100, 150, 200, even 500, there your negotiation, even my negotiating power is a little higher. And there I'll be the first one to tell you, no, you buy from the secondary market. At least these days I tell people I will never sign off on something which I personally can't do. But with the 200, 300 million, getting you 17.3, 17.4 is easy. And then you can go and invest. I see a few hands. Yes, I'll start with Stephen. I think he put his hand first.
Thank you, Alex. I have two questions.
Yes.
First, and both of them relate to yield to maturity or the interest rate. So, on the primary market, how is the yield to maturity also determined after the auction? Then my second question is, if I go on the secondary market to a bank or a dealer, and I get information on the interest rate I get information relating to just one bond, how do I know the information is good if I don't have anything to compare it to?
Okay, that's good. I'm going to take an answer, then I go to someone else, right? On the primary market, the auction, the yield to the interest rate is determined on the day of the auction. You can never know until the results are done. Never. One. So that's the risk we always take when we go to the primary market. We have an assumption. Once in a while, it burns us. There are times when we say, hi, we're about to get a 16.5, and you leave a deal off the table of 16.3. Like, let me go. Then BOU rejects a lot of bonds, and then all of a sudden you have a 16.2. Then the next day, all the rates go down to almost 15 plus. It happens. That has happened a lot. You can never know until that the auction day. The second one, how do you know? Now, I'll come back to this for a second. Where is it? Where are you, my friend? How come I can't see you? This. Except if you have access to certain information or you subscribe to some of these things, banks can only tell you what they want you to know. If at any one point you are investing more than 100 million plus and you're about to buy a deal on the secondary market, I always implore people, take a minute and get yourself an advisor. They are going to charge you. I charge at least 500, 600. People here can attest. But I know a few people who also charge a little bit more, but it might be more protective for you. Because the banker can give you a 16.5 only for someone to bring you a 17. And how is the person going to bring you 17? Me, I'm going to just come here and I'm like, wait a minute, I'm seeing it right now. Yesterday it traded at 16.7. So I'm not taking anything less than 16.7. I'm taking 16.5. Yet for you, you do not have that information. You're taking at 16.2 and you're thinking it's a good rate. Yet that last happened on what? Like 15 to 20 days ago. Now me, I have latest information. The banks have this. It's the funny thing about this is about treasury bond is the information is open, but it's not yet too open. So that's where you want to be like, I want to get different rates for different bonds. Reach out to someone who is into this full time. They will give you them to you. And then you go negotiate based on that. Or you tell them, go negotiate for me. I have my 200 million. How much do you charge? If you have 200, 300, 100 million plus, and they're going to save you 4 million off the cost, paying them 500k isn't that much. You would have recovered it from the savings. They would have saved you a net savings of 3.5. Yes, Gilbert.
Yeah, thanks, Alex. If we could go to the Bank of Uganda calendar, the auction calendar, I just wanted to get some clarity. Yeah. For instance, in this line where we are, the 19th to 20th, when you go to the 10-year bond, I guess there was something like reopen. When you scroll to the right, yeah. What does that mean? Does that mean that it's going to be a new bond on that day that whose specifics we do not know? Is that what you're saying? Just wanted that clarity. Thank you.
It's called reopening. It means they're bringing a bond which we already know about. So for a new bond to be a new bond where you do not know anything about it, it will be called new bond. You see here at the top, it will be called new bond. Now, if every time they bring it back to the market, they will be bringing it reopen. After this calendar, they will update a new calendar and they will start putting there the UG something number. So we always know.
Okay.
Yeah.
So
Yes.
just a rejoinder, Alex, before you go to the next. So the UGX and these specifics come just before the auction or when it is a reopen?
2 weeks to the auction. So
Okay,
every time 2 weeks to the auction, they have to. Sometimes they delay and they publish it a week too, but you would at least know what they're trying to sell.
Okay,
before the auction. Such that when you're filling up the form, you are filling it up in knowing what I'm trying to buy.
Okay, thanks.
Yes, Juliet.
Yes, Alex, 2 points. One, these bonds are long-term, 5 years, but should I, at one point, maybe I have a challenge and I want to get my money back, if you could talk about the penalties of withdrawing earlier, if it's a possibility, and what does it take and how much do I lose? Then the other point is, Alex, you seem to talk so much about people 35, 45, but maybe they're also older people. So let's know, I mean, how can we make money from this? Maybe I have 5 years to retirement. Should I continue with this?
Okay.
Thank you.
Thank you. I'll start with the first one of when you want to sell your bond. By the way, for all this conversation, I've tried not to pin it on the bond versus real estate because it gets a little bit heated. But let me start from this way. You have a higher chance of getting your money from your bond in one day than it can ever happen in a treasury, in a unit, in land. Realistically, you can go to the bank and say, I want to sell my bond, and they will give you your money. In one day, it will be on your account. Latest 48 hours. If you are good on the deal today, the next day, the money is on your account. The question is what Juliet has asked about penalty. Now, I'm not going to call it penalty. Let me come back to this. Treasury bonds, now most of us are, I would say, majority of us should be investors. What I mean is buy a bond and try to hold to it as long as possible. But that doesn't mean happen all the time. You should always, coming back to the yield, the interest rate, you should always try to buy the bond when interest rates are high and sell it if I'm to do the maximum, you want to buy a bond when interest rates are high, and if you are to sell, try to sell when the interest rates are falling. Because when that happens, it means you're going to get more money than what you bought your bond at. Unfortunately, you're not going to get a penalty. That's someone who is strategic enough. When they say I bought at 17.4, I sat with my bond for 2 years, then interest rates started falling to 14, I sold it, I got more money. However, what happens if it's an emergency and you need to sell that bond? The question is, you don't need to sell all of it. Let's assume you have 40 million. Your emergency is for 2 million. You need that 2 million. Just sell off just enough, 2 million. You don't need to sell off 40 million. 2, there is a possibility that what you bought at 2 million, you're going to get 1.9. That is not a penalty. The penalty, it's how on a particular day that you're trying to sell, how the bond is being priced. Unfortunately or fortunately, bonds are priced daily. The market prices them. That's why you can come to me today and I'm like, I can get you a bond at 90 shillings for every 100. And you go and think about it, sleep, wake up. 2 days later, I'm like, no, it's no longer on the table. It's now 92. It's not like I've changed. It's because the market has moved on. Things like right now, we're about to go into the parliament budget reading and everything. That impacts the interest rates every single minute, every single day. Right now, Trump is coughing up with the aid, and we are seeing that. We are waiting to see how it's going to react next week to the market. This judgment done by the Supreme Court and today's news from the president, that impacts the interest rate and it impacts the price. So when you are time for you to sell, if it's not, that's why we always tell you from a full investment advisor, I will say, have some money in a unit trust up to the 10% of your value, then let the money be in the bond. What that does is you allow your bond never to be distorted in price by such changes, that if you have an emergency, you can go to a unit trust. But 2, even if you have a 10 million bond and you just want 1 million, just sell off just 1 million. Let the 9 million continue to go. And 3, for as long as you do not sell your bond in the first 1 year, you'll never make a loss on it. What do I mean? Let's come back to this. Imagine you bought a bond of 60 million. In Feb, it gives you 3.4. You paid close to 60. So here, in the first year, it gives you, in Feb, it gives you 3.8. Then it gives you another one. That's 7.6. Then after in 2026, you want to sell it. Then someone tells you, oh, you have a 60 million, I'm giving you 58. So then they give you 58 million. At that point, you will say, I've lost 2 million. But you have not lost it because you've got 58 plus the 7.6 is 65, more than what you paid. So for as long as you are an investor and you hold your bond for at least a year, you will never make a loss of it. Now, the longer you hold it, the longer you make a profit of it. Because remember, for it gives you money every now and then. Just 1 year, and you are good to go. And the point which, and also to even add on to this, is to say, for as long as you, coming back to this, let me even take this out. You started with 10 million and you keep on reinvesting this money. Now, in 2029, you want to sell your bond. It's no longer 10, it's 18.4. Now, even if someone gives you 17.5, you have not lost anything. You have made a profit of 7.5. But there is also a possibility, and we have seen it happen, where someone can give you 19 because maybe at the time you want to sell, the interest rates are falling. You want to sell when interest rates are falling, especially if you bought when they are high. Now people do the opposite. They buy when interest rates are low, and then when they see interest rates up, they want to sell and it's buy a new one when it. That's where they make losses. It doesn't work that way. It works the opposite. On the second question, which I've asked Juliet, for people 50 and above, they're about to retire. Retirement isn't the end in itself. Recently, like 2-3 weeks ago, I had the transaction for someone who is already retired. They got their pension around 150 million, not so much. They were a teacher, 150 million. And they said, what? And their daughter brought to them and like, Alex, we want to see. We think what you are saying is true, but how do we convince mom? So we sat down and we said, okay, how much do you need to live off every single month? That 1 million. Okay. You don't rent, you don't what, you are in Imbarara, that's fine. 1 million is a good one. You have this money. If their goal was to go buy a farm or buy rentals, I'm like, no, do not do that. How long do you think you can live for? And that's it's a genuine question. Like, yeah, you might live up to 85 plus. That means you have 25 years to go. You do not want to be a burden to anyone whatsoever. Okay. So I need to just make you 1 million a month and you are good to go. So we presented this. Right now at I said you have 150 million, I'm going to live with you 10 million. Put it on your account for you to take you through this first year. Okay. So that means we have 140 million at 14. Then I told her at 14, it means every 6 months you're going to be given around 9 million on your account. Yes. Every time they give you 9 million, you do for me one thing. Withdraw just enough for the next 6 months, which is 6 million. In a year, that's 12 million. And just keep doing that. Whatever remains on the account, put it back in another bond. Because it's giving you 19, you only need 12 million, 1 million in a year. If at any one point you need a little bit more, it's okay. But I assure you, for the next 20 plus years, we bought a 20-year bond. We bought it from Stanbic. They gave us a really good deal. For the next 20 years, you are guaranteed a salary, an income, not salary, an income of 1 million plus per month. Whether you eat it, whether you don't eat it, it is going to come. That because you're a parent and I'm a parent, you're not going to bother your child. At least you have a starting position. Even if at one point comes and you have an emergency, maybe a health emergency, and you need 2-3 million, you can still at that point withdraw. Let's say if you are to withdraw maybe 20 million, it's okay. Either way, it's your money. It won't slow you down. And then this 140 million will continue taking care of you. You can see, even if they are to withdraw 15 million, 14 million here, and let's say you are 50 years or 55 years, and man, these days our age where people they start getting at a high risk of living us is 70, 75, 80. So let me give it to you up to 80. So you're 55 years. It means you have 25 years on this world where you want to be in control of what you eat, what you spend, when you do not need to call anyone. People don't look at you every time they see a message coming in and they be like, oh, they want money. So you are about to retire with your 140 million. This is what they had. So we said 14 million for the next 20 years. If you just keep going there, your money will keep growing. But even if it doesn't matter, that at one point you're going to increase it to 20 million, because the cost of living might increase, that's okay. You do that. Your money will continue growing. The goal is to make sure you're just eating the coupons. Do not eat the capital. You will never see someone who has invested in a unit trust. They will never in a rentals. They will never see where you have passed. You're not struggling with anyone. Your money is coming on time. You withdraw whatever you need. You invest the rest. Withdraw what you need. You invest the rest. And two, at one point I wanted them to even buy like 3 bonds, which bring in money almost every 2-3 months. They're like, I'm okay. You have given me the first 10 million for me to last for a full year. I can reinvest this. By the time the other money starts to come in, this one would have taken me for 10 months. Then the other one comes in, I take off the 10 million, I invest the 9 million, and we created a very good plan. And I hope they follow through with it. And her daughter was happy because for all of a sudden she could see what cash flows can do for her. So now, bringing in the concept of cash flows is for this, that for someone young, the 35, 45, where most of us are, even 50, at that point, you're not worried at cash flows if you're still employed. At that point, you are worried that your goal is to maximize. So this column will be empty. You know? What it should be, it should be this column where you say, I can, for as long as I'm still earning, I can even add in an extra 5,500K time per month. Oh. You know? Then if you are 45 or 55, you have 100 here. Let me call it 100 here. Then you're going to earn for the next up to 2030, you retire. So you can no longer add any money here. Done. But by the time you retire, you need a 2 million to live off your life. So then this column changes to come to 2 million here for every month. Then you withdraw your 24 million forever. Then you would have set cash flows coming in for you for God knows, even if you lived up to 90 years. And your bond, for as long as you do not withdraw more than what it comes every single year, it will continue to compound. And if you are at 55 here and you find yourself at 85, you'll still have some income to what? To make in. And there is a concept I'm going to start writing on in maybe March, the concept of legacy, where we are, as parents, you're like, I'm better off leaving such a cash flow for my kids more than an asset, because you are leaving them an asset. You're like, at night I'm going to pass on when I know there is some income coming in, whether they are withdrawing all of it or they are withdrawing some of it, but at least they have an income. Whether now the Kampala would have improved and we have jobs, enough jobs, or it would still be terrible where people, many of us as unemployed, at least something will be coming on their account for them to withdraw and spend on that and have the best human needs without any struggle. I hope that answers your question, Juliet.
Yes, please. Thank you. Thank you.
Perfect. Yes, Edith. And I know we are in the question session. I don't know if I've left out anything, so ask as much questions as we can.
So, you said that there's somewhere where you mentioned that you would advise for us who have like 5 million to start off with the secondary market. But now, which banks would you recommend for us to go to? I visited a couple of banks, but it looks like a lot of these tellers have no idea what's happening.
Which bank are you in? The bank you bank with?
Right now, I'm banking with Centenary.
Stay in Centenary. Just go to the head office. You have to, you see, the tellers do not know because this is a new concept. They are used to the loans and everything and cash saving, right? But they should know. So go to the main offices in town. When you just insist, just say, I need to, if they say they don't know, tell them, connect me to the Treasury back office. Every bank has that office. It's either Treasury.
I was at Mapera.
And
I was at
Mapera doesn't
Mapera
know.
House.
Wow, that's interesting. I know one person here who is in Centenary and they have invested. But if not, if you want me to just recommend for you another bank, I would say go to Housing or go to ABSA. They are really good. And by the way, for ABSA, they do not even charge primary charges. That's 23,000. They do not charge it. So ABSA is a good one.
Okay.
Yes, Nicholas.
Thank you, Alex. Kati, even me, the thing is about the banking section. Because if you're assuming you're out of the country, you this is something you have to do physically. You have to go to the banks. Otherwise, is it possible to get legal notice like the way you do for other transactions, like we do back home in Uganda, where you have someone and they have you have legally assigned them they have the papers to do your financial deals in your names. Is it the same case with this documentation for Treasury bond in case to follow through and send the person? Can he be able to access that in the banks? And then you talked about, Equity Bank, that's my bank, my banking section. I don't know if they also have it in the branches, but we'll try probably to visit Church House and see. I'll send the person to Church House and they can check to see if there is an option for that. I'm interested in the February primary market to see how to enter in and start. This is a new venture for me. Yeah. I'm just a freshy person here. I've been doing other investments, but I'm slowly converting to it. So I would like to know, do I need to physically be there to do it, or can I even do it from this side using my equity banking app, the way I do for other transactions? Can I be able to do it through my banker from this side? Or do I need to can someone go and represent me in Uganda, or should I have to get also into ABSA or get another bank to work with?
Thank you so much. The fact that you have an active account, you should be able to invest. You just have to reach out to the bank. Even I'm assuming you have a communication line on email. What banks do these days, you can tell them, I'm going to be communicating on email. Then they will give you someone you have to communicate with. They will give you what we call an email indemnity, because they don't want you to come later and say, I didn't send that email. But for Treasury bond, it's okay, because either way, when you send the email, it's moving your money from Equity to Bank of Uganda, so there is no risk whatsoever. It's actually more safe, So you just activate what you'd call your email communication, email indemnity. That when you fill up the form and sign it off as you, when you send it on email, they can action on those activities. That's what you should ask your bank. You should be in position to do it. I'm not in the country. I send through everything on email, and I have never had a problem. Equity is good. They have, when it comes to secondary market trading, they have here and there a few things, but I found them also legitimate. When I want to do a transaction, they have not stressed me that much. But yeah, you should be in position to communicate to them, and say, I'm not in the country. Can I do it? Even when you send someone there, you say, okay, what will it require? Because what is most important is when you fill up this form, is the signature here. At the end of the day, they're going to verify this signature. Now, if that signature is not yours, they will never action on that activity. It's not like you can give custody for someone to sign off for you. Two, if for one, and specifically for you, Nicholas, you get this form where you are, print it out, sign like 10 copies or 20 copies, put them on the plane, send them home to someone. Just sign off here. That's all. Now, every time you are buying, that person can just fill up this. Okay, you can sign off here and the CS and the CCSD and the name. These two, and this one here, and the signatory. No, actually, this is for commercial bank. I meant this, right? And fill up these details here. So do not fill up this, don't fill up this, don't fill up this. Send like 20 copies, send them home to someone. Now, every time you want to buy, you tell them, get a copy, put the security type here, because this one changes anytime, put it there. This one, you can even fill it up, it's Bank of Uganda. Now, this one, it's a matter of saying 5, 10 years, or 15 years. When that is done, they get your copy, they take it to a bank. That's it. Because that's your instruction. For them, they're just delivering it. There is no risk to that. So that would be something you can think of. So you can do Feb, if you have to action that, you can want to do it by Monday, courier them, they are in Kampala by Friday, whatever, and figure it out. The other alternative, see if you can communicate on email. Yes, Gilbert.
Yeah, thanks, Alex. Mine, I think, is I just wanted some bit of clarification on exactly how to calculate the all-in cost. I think I got the principle, but I don't know whether I got it very right or I missed it. How do you exactly calculate the all-in cost? Having known the yield maturity and the coupon, how do you exactly come to the figure of the all-in cost?
Now, that is, it's driven by a few formulas, but to show you, for example, this one, right? For as long as it's driven by three things. One, when was the bond issued? How long does it have to go? How long does it have to go to pay the next coupon? You know, and what is the coupon rate actually? The coupon rate also impacts it somehow. So all those three things factor in to create all the different formulas that would end up coming into that particular whatever. So every time when the bond is about to reach when it pays a coupon, the all-in cost goes up. When the interest rate changes, the coupon, the all-in cost goes up or go down. When the bond is about to mature, the all-in cost goes up or goes down. When the bond is about to pay, it has just paid the coupon, all-in cost goes down. There are so many other things that impact it.
Okay.
Yeah.
Thanks.
Yes,
Thank you.
Edith.
Did I did I raise my hand again?
Oh,
No.
that was it. Yes, Caroline.
Yes, thank you. I just wanted to know, Alex, what would be your advice? What would be the best advice if I want to, let's say, buy a 10-year bond and I don't want to have the hassle of having to go back and sign to reinvest? I want to put, let's say, 50 or 100 million there and forget about it. Can that happen?
Banks haven't yet come up with it. I don't know any bank which has come up to that, but I would say it's not wise. I'll tell you why. Let's come back to this. Imagine you buy your bond here at 18 or 17, like right now, or maybe here right now where we're at 16, right? And it pays a coupon in 6 months from now when rates are at 14. And at that point, there is a better bond. But for you already instructed that they just have to keep buying exactly that. It's you losing out. You see, rates change every now and then and they impact the price. You want to make sure every time they change, it's once every 6 months. There is going to be that pain of activity. And that's why some people say, I prefer a unit trust or a money market fund because I put my money there and I forget about it. What they do not see is that you have locked in 11% for that. For lack of better word, let me say, for the comfort of you not doing anything, you have locked in 11%. The discomfort of you getting 14% and above, once every 6 months, be willing to say what bond is trading, what rates are they trending at. Otherwise, the bank will end up selling you a bond at 14.5 because either way you're not noticing it, the money is there and they just keep taking it. The alternative, which I've seen happen or which I'm working on, is people will say, Alex, I do not have time to monitor this. Is it possible if we do this a structure and say every single now and then, you know which bonds I'm investing in, like what the client have showed you their portfolio. I know when the money is coming in. Before the money comes in, I already have the forms. I just send them to sign off it. The next time, by the time the money hits, the other form has gone to the whatever bank. So their only activity once in a while is always to say, oh, Alex is going to send me a form to sign. Then after the year, we're like, here is Alex, your income for your retainer for your what you have done. But they don't need to be the one to monitor the market every single minute because they do not have that time. So that is an alternative you can take. But it also helps you because even which bond I choose for you to sign off and buy, it's dependent on where are you going to make the most money. It changes every now and then. The bond that made money in 2022 is not the one which is making money right now. What makes money right now is not the one which is going to make money in 2 years from now. Now, if you lock it in all in 10 years, you might as well put it in a unit trust and get your 11% and you move on.
Okay, so if I'm getting you correctly, I'm just trying to understand what you said. I must be able to watch the market. And where do you watch it from? For some of us who, for example, are not in the country and you're very busy, where do you watch it from? But if I am, let's say, someone is going to contract Alex to do that, does it require that when you know that is a better bond coming, you advise, let's sell, and then all I have to do is sign?
Yep. So there are two ways to monitor the market. The best way is to say you monitor your cash flows. It's a matter of saying, okay, I have 100 million. I expect money to come in May. In May, that's all you have to think about. Like, oh, money has come in, Alex. What bond is out there? It's a simple text. I'm like, you go for the 10-year bond. You fill up that. You fill it up, send it to the bank, they execute your auction. Well and good, you're happy, you're good to go. The alternative is, Alex, you know which bonds I have. By me having your bonds, the portfolio, I know when money is coming for you. So that means it's me to trigger to know, okay, in May, I know Caroline is going to be paid 6 million. Now I can see, I monitor my market from here. I know which bond is coming and which bond has more money, which bond has a little rate. So then I'll fill up the form and I send it to you, you sign and you send it to your bank. It doesn't need to mean you're going to be monitoring every single day. You monitor based on your cash flows. So the other alternative is for you like, Kakande he writes on the bonds every 2 weeks. For as long as I know when my money comes, that means whatever email he's going to write, I need to pay attention to what it is, which bond it's saying, and I just fill up that. So you don't need to subscribe to this, pay me a lot of money, and you have to track everything and like what are the changes. No. That's why for a retail investor, I write it and I say, this is where you make money. Go for this. Because I'm part of a retail investment. When you go to the bank, you'll be like, this is what I want. Alternatively, is where someone says, you monitor it. Now I know your portfolio. I know what money is coming in. We even before even I onboard you in that regard, I know what you're trying to do. We set up certain goals and targets. So for me, it's the target to say that in 10 years, you said, I personally, as me as Carol, I want to have a 2 billion portfolio in 10 years. So then every single now and then when cash comes in, is for me to make sure which bond am I buying that is guaranteeing you maybe a 14 and above that will one day make you have a 2 billion in 10 years. Then I just action on that. Yes, Gilbert.
Thank you.
Thank you, Alex. Mine, I think, is a little bit related to. I have two. One is related to Carol's one. I want.
Have I lost you?
One would get. Sorry. Can you hear me? Sorry, someone had called. I wanted to confirm. I wanted to ask maybe how you would guide in terms if I wanted to get access to a router system or to get this information. Where would I get it from? And then two, just to clarify, that the interest rate only affects my my buying, my purchase, my buying cost, and then the rest of the time of my bond tenure is affected by the coupon rate. I don't know. Is that the case?
Yeah,
just
that's
to
true.
Clarify.
Yeah, that's true.
Okay,
It impacts the cost. So you always want to buy cheaper. On where do you get this information? There are two ways. BAU publishes this information. It's one of those things which you can always try to go and monitor, but you also have to be patient. Okay, their system isn't even working today. Unfortunately, I'm sorry. I know it's the worst day for me to try to show you where it is, and somehow it's not working. Let me see if this alternative one will work. Give me a second. No, I would not. And the problem is the BA what they publish would not show you how this moves. Okay, let me see if what I want to do will work. Okay, this side it has worked. So when you come here, there's what we call here daily secondary market. Let me put this link here. Oh, come on. Okay, it has I don't know why the system is not working. I can't lie to you. Some of it is working, some of it is not working. But Let me see if I have something which I wanted to show it to you. Okay, it has refused, but if you go to that page, it will have something like this. Deals that have executed. Now, the problem is, when people come to this, they think this is the representation of the facts of the day. All right? This was on 23rd. See these bonds?
Yeah.
So when people go on here, and that's the challenge with, and that's the market, unfortunately. Let me not even blame it. It's how the market is designed. It's a little bit open but skewed. See this person, he bought a 20-year bond at 20 million at 15.3. And when I come here and I see 15.3, I'm like, man, you paid too much money. A 20-year bond should be at a minimum 16.5. 16.5. Now, when you come to the market, to the bank, they are here to make money. You have to understand, it's not the, I want to be fair, but they are here to make also money. So for you, when you go to Bank of Uganda and you see this, that's the information they are feeding you. But they are feeding you information of deals that have already taken place. So now that's where you have to take a little bit of a step back. Things as simple as, Alex, I want to buy. My WhatsApp number is, for those of you who have never interacted with on WhatsApp, my WhatsApp number is, I'll put it in the chat. It's as simple as, Alex, I want to buy a bond. I have 100 million. What rates are they what rates do you think it is? I'm not going to come here. Of course, I'm going to come here and I see some of these deals and I feel the pain of someone paying that so much money like that. You know, let's look at it here. Let me show you let's use that 20 million person. This is the bond they bought. So for me, if I'm like to pull it off and I get it at 16.5, 20 million. So they would have got it at 18.5 million. They paid 19.7, 1.2 million over and above. Now think about it if you're buying a bond of 100 million. You get my point, Gilbert, right? So it's a matter of, part of the monitoring of information is, say, Alex, I'm about to buy a bond. The bank has given me this rate. What do you think? I will never charge you for it's a minute, man. It's a minute of me coming here and check the rates. I'm like, this is what they have given you. Okay. Then I'm like, let me check here. Price history, and I track a few things. I'm like, what they are giving you is not good. Then I'm like, oh, so then you go back and like, how do I negotiate better? Because at a minimum, they should be giving you 16.2. Someone was given 15.5, you know?
Yeah.
So that, I've put it in the chat. You should be in position to see it.
Yeah, I've seen it. Thank you, Matt.
Carlo, you should be in position to see it. Okay, I know we have.
See it. I don't know why.
You don't see it?
Nope.
I'll read it. Or let me type it somewhere here. If you can see this, where? Let me type it here for anyone. +256 771 404 377. So I know we have 5 minutes. Let me stop my recording here now. I'll upload this on YouTube and I'll send you a link on